Investing is a long-term strategy that, when done correctly, builds wealth over time. Most experts agree that regularly putting money away is one of the most effective ways to grow your wealth. However, attempting to time the market, buying when prices are low and selling when they are high, is often considered a losing game. Instead, many investors, either intentionally or unintentionally, benefit from a strategy called dollar-cost averaging. This method allows individuals to grow their investments consistently while reducing risk. My name is Mich, and I teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. So, what exactly is dollar-cost averaging, and how can it benefit you? Let's explore how this investment strategy works and why it is favored by so many financial advisors and experts. What is dollar-cost averaging? Dollar-cost averaging, or DCA, is a simple yet powerful strategy where an investor regularly contributes a fixed dollar amount into an investment, such as a stock or mutual fund, on a set schedule, regardless of the asset's price at the time. This approach spreads the investment over time, allowing the investor to buy more shares when prices are low and fewer shares when prices are high. The ultimate goal is to lower the average cost per share over time and minimize the emotional impact of market volatility. Many people are already using this strategy, often without realizing it. For instance, if you have a 401k or retirement account where a set portion of your paycheck is automatically invested, you're already using dollar-cost averaging. The idea is to invest consistently, whether the market is up or down, so you don't have to worry about trying to predict market fluctuations. The benefits of dollar-cost averaging. Dollar-cost averaging can be particularly helpful for long-term investors, especially those who may not have the time or knowledge to closely monitor the market. Here are some of the key benefits. Reduces the risk of bad timing. One of the biggest challenges for any investor is determining the right time to buy or sell. The stock market can be unpredictable, and even experts can't always forecast when the next market crash or boom will occur. By investing a fixed amount regularly, you remove the pressure of trying to time the market. Whether the stock price is high or low, you'll continue investing, which smooths out the volatility over time. Takes the emotion out of investing. Market fluctuations can make even seasoned investors nervous. It's common for people to panic and sell their investments when the market drops, only to miss out on the gains when the market eventually recovers. Dollar-cost averaging helps eliminate emotional decision-making because the strategy is based on automatic, regular investments. You don't have to worry about the market's short-term movements, just stick to your plan and keep investing. Allows you to buy more when prices are low. One of the natural advantages of dollar-cost averaging is that when stock prices are lower, you end up purchasing more shares for the same amount of money. Conversely, when prices are higher, you purchase fewer shares. Over time, this helps lower the average cost of your investments, builds discipline. Regularly investing a fixed amount helps instill financial discipline. Whether the market is going through a downturn or reaching new highs, the key to successful investing is consistency. By contributing the same amount each time, you stay committed to your long-term financial goals. How dollar-cost averaging works in practice. Let's say you contribute $500 every month into an S&P 500 index fund. In January, the price of the fund might be $100 per share, so your $500 buys 5 shares. In February, the price drops to $80 per share, allowing you to buy 6.25 shares. Then, in March, the price jumps to $120 per share, and you only buy 4.16 shares. After 3 months, you have invested a total of $1,500 and purchased 15.41 shares. The average price per share, in this case, would be lower than if you had invested all your money in January at the $100 price point. Over time, this strategy helps lower your average cost per share, especially during volatile markets. By sticking to a regular investment schedule, you don't have to worry about the daily ups and downs of the market. Whether the market is experiencing a downturn or an upswing, you're continually investing and taking advantage of market dips when prices are lower. Why timing the market is risky. Some investors try to time the market by holding off on investing when they believe a market downturn is imminent, or by waiting for the perfect time to buy when prices are low. However, the reality is that even experts struggle to time the market consistently. The stock market is influenced by countless factors: economic conditions, political events, global pandemics, and trying to predict the best time to buy or sell is nearly impossible. History shows that missing just a few of the market's best-performing days can significantly impact long-term returns. For example, if you had missed the 10 best days in the stock market over the last 20 years, your overall return could have been cut in half. This is why it's crucial to stay invested, even during periods of market volatility. Dollar-cost averaging protects you from the risk of making poorly timed investment decisions. By investing regularly, you ensure that you're always in the market, taking advantage of both the highs and the lows. Over time, this leads to more consistent returns. Should you invest a lump sum or dollar-cost average? Let's imagine you receive a large sum of money, whether it's from an inheritance, a bonus, or lottery winnings. Should you invest the entire amount all at once, or spread it out over time using dollar-cost averaging? Research has shown that, on average, lump sum investing can yield higher returns because the market tends to rise over time. However, the risk is that you could invest your entire lump sum just before a market crash, which could result in substantial short-term losses. Dollar-cost averaging, on the other hand, reduces this risk by spreading your investments over time. While you might miss out on some potential gains by not investing the entire amount right away, you also reduce the chances of making a large investment just before a market downturn. For most investors, the reduced risk and emotional peace of mind that comes with dollar-cost averaging make it a preferable strategy. The role of automatic contributions. One of the simplest ways to implement dollar-cost averaging is through automatic contributions. Many 401k plans and retirement accounts allow you to set up automatic transfers from your paycheck into your investment account. This takes all the guesswork out of investing. You don't have to worry about remembering to make a contribution or dealing with market fluctuations. If your employer doesn't offer a 401k or automatic investment options, you can still use this strategy by setting up regular transfers to an IRA or taxable brokerage account. The key is consistency. Whether it's weekly, bi-weekly, or monthly, the important thing is that you stick to your schedule. Dollar-cost averaging during market volatility. During periods of market volatility, it can be tempting to stop investing or even sell your investments to avoid further losses. However, market downturns are precisely when dollar-cost averaging becomes most effective. As stock prices fall, your regular contributions allow you to buy more shares at a lower price. When the market eventually recovers, those lower-priced shares will increase in value, boosting your overall returns. This strategy helps prevent the common mistake many investors make, selling low and buying high. By sticking to a regular investment schedule, you avoid the temptation to react emotionally to market fluctuations. A real-life example of dollar-cost averaging. Let's take a closer look at how dollar-cost averaging works in practice. Imagine an investor who starts contributing $1,000 to an index fund every month at the beginning of the year. Over the next 5 months, the share price of the fund fluctuates as follows. January, $50 per share, 20 shares purchased. February, $40 per share, 25 shares purchased. March, and $45 per share, 22.2 shares purchased. April, $55 per share, 18.18 shares purchased. May, $60 per share, 16.66 shares purchased. After 5 months, the investor has contributed a total of $5,000 and owns 101.94 shares. The average price per share is approximately $49.06, which is lower than the highest share price of $60 in May. By consistently investing, the investor has taken advantage of the lower prices in February and March, lowering their overall cost per share. Dollar cost averaging versus lump sum investing. While dollar cost averaging is a great strategy for reducing risk and avoiding emotional investing mistakes, it's not always the best choice for every situation. Some studies suggest that, over long periods, lump sum investing may result in higher returns, as it allows more of your money to be invested in the market sooner. However, lump sum investing comes with higher short-term risk, especially if the market declines soon after your investment. Ultimately, the best strategy depends on your personal risk tolerance and financial situation. If you have a large sum to invest and are comfortable with market fluctuations, a lump sum investment might make sense. If you're more risk-averse or concerned about market volatility, dollar cost averaging offers a safer, more disciplined approach. Conclusion: dollar cost averaging is a time-tested investment strategy that helps reduce risk, build wealth over time, and protect investors from the emotional ups and downs of the market. By consistently contributing a fixed dollar amount to your investments, you can take advantage of market dips, lower your average cost per share, and stay focused on your long-term financial goals. For most people, dollar cost averaging is one of the simplest and most effective ways to invest. Whether you're just starting out or looking to grow your retirement savings, this strategy allows you to invest steadily without trying to predict market movements or time your investments. By automating your contributions, you can focus on other aspects of your financial life while building wealth for the future.